Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. I'm Rapstein, and here we are on Wednesday, and this is quite a Wednesday, isn't it? If you've been keeping up with the markets, December 14th, 2011, just after 3 o'clock. $86 break in gold in the last price, $2.50 for all purposes in silver, 17 cents in copper. You'd wonder what it is because the euro currency is only down $0.50. You're up all of 27 points in this whole move in the dollar index. So what's going on? What's going on is the realization, and I don't know why it's taken this long. I don't have the answer for that. But that Europe blew it. Simply put, blew it. The ECB not coming to the rescue very much there. We're looking at when the EU got together over the weekend and they struck this agreement that has to be ratified, hopefully by the end of March. And you sat back and the market thought about it and said, you know, they still don't get the urgency of what has to be done. I remember how the U.S. handled this, and it was very different. You may agree or not agree with TARP and what it did, but we addressed an issue in a very fast way. Sometimes fast, like QE2, you question who did it really benefit. But QE1, that was definitely needed. The TARP package got the job done, and they've blown it in Europe. And now the world markets have reacted to that, and that's the problem. The gold market that we talk so often about here, I've been mentioning for a while that the gold needs a story. It's not buying into the Iranian situation that Israel will attack them or that Iran's going to close the Strait of Hormuz. That story did nothing. It propped up energy prices yesterday, and it killed them today. You're down $5 a barrel in crude oil. So the sucker play was that, and they made the people pay for that. In the gold market, you haven't, with the European Union, moved the gold higher. That story played itself out. The ECB going to open up its ammo and inflate the market. That didn't happen, so the market came down. There's one story that gold needs, pretty evident, at least at this point in time. It needs inflation story, and it's getting the exact opposite as the CRB index continues to crash to new lows on this move, and that has been the doomsdayer for these particular markets. Take a look at this gold chart. You know, to me, where the market really ended its uptrend on the daily chart was right here, 1705.70, not where it's at right now. I've written many articles how important I think the close of July 31st is at 1621.70. You're right now $50 away from it, and today is the first day that you've challenged this number, if you think about it. Let me turn this way here, since October. So that doesn't mean that you can't swing down under it for a bit here and then eventually get a rally back to it. But I think come the end of December, whether right or wrong, I'll stick my neck out, that the market will be at that number or higher. That does not mean the market is a buy where you're at right now on the downside. If you buy it here, what makes you think it can't go down another $50? And it can't. It was recently at $15.35. I think that many technicians will say that is where this market might likely head right now. But when I step back from a market and I look at a market that just 5 days ago was 1760, and now the market is pushing 1565 as a low today, I go, whoa. I understand people are bailing. I understand there's margin money. I understand all that. But selling rallies, not selling this deep of a break, makes more sense to me. It's that simple. The 18-day average of closes back in the 1707 area. It'll get down to this area that it was at before. You haven't had any rally since 1760.50, so we don't know how deep this break low will go, but you cannot deny the fact that you've got lower highs, and once you took out 1705.70 and you broke that low, that was it. You know, when that happened, I had told clients on the break, on the pullback here, to buy the market using the micro contracts, these small 10 ounces at that time, and keep the stop at 1705.70. I remember, and this was just a few days ago, walking around the office wanting to hit my head against the wall because the market had stopped me out and I was becoming so blinded that I thought the market had to go up with what was going on in Europe. But that is what the discipline of reading a chart is. To get short under that number, I had a risk $55 in my trade recommendation, and that was the right trade, but it was too big of a risk as I saw it. And it's never given you another chance. So there was no getting in or out. In fact, people that watch this happen, because I was getting emails about it, oh, don't you think it's going to come back up? And I said, I don't know. I don't think it's going to. It doesn't have to. Because if you close the name of the chart and you just look at the pattern, it looked bearish. I did not think you were going to drop $2 from there in this short a period of time. So now I go to the market, I close the name of the chart again, and I say, hey, how often do you stay under or over these black lines, which are called Bollinger Bands? And typically when you're above them or below them, it means you're getting into an excessive area. And that's what I think is going on in gold. I think we're getting excessive to the downside, which doesn't mean I'm picking a bottom. I'm the person mentioning that 1535 area, and that doesn't mean you can't just get on the other side of the line and ride it down. I am in the bear camp in the market. I see no reason to be bullish right now. I do think the market can get back into that 1621 zone in a short period of time. There's only 2 weeks left in the year, and I'm refusing to tell you where to buy it because that's not the play. The play is the trend is down, but it's oversold. When you come to this chart and you start looking at the slow stochastic study, you see the oversold. The red line is under 20, but the brown has days before it would get under that with it. So in a day or two, I'm looking for the market to at least stall this amount out, and this is not a spot that I could in any good faith tell people you go short at. Where are you going to put a stop? $2 higher? You're better off not playing. That's my opinion. Silver market's the same thing. It just came unglued today. And it's under that Bollinger Band. And again, if you come here, you can get over the Bollinger Band for a few days. But more times than not, you'll get to that area, you get that extreme, and then you start bouncing. I have no reason not to think that's it. And that is not a reason to get long the market. It is a reason to cover shorts. Very big difference. Then we get to the copper, which finally today, this platinum. The platinum has been making the lower lows, lower highs, and that's never bounced. And it has a seasonal buy at this time of the year. That isn't working whatsoever. Because you're getting a counter-seasonal move down. And the copper is the market that has just yet to approach the Bollinger Band. So of all the metals, this has actually been, if you just are a chartist, close the name of the chart, this has been your strongest, but it's still in a downtrend, and has been ever since it got under 350, 280, and you're now pushing 327. Getting short, very difficult. Money management is the hardest thing in the futures markets. I find that my work can call a trend pretty neat. It's the money management part that's always been the hardest. Do you really want to risk that big a trade? I think if money were unlimited, it'd be pretty easy following just the technical disciplines. But you can't do that because this is a real world. So what I like to think of myself, I can call the general trend of the market. I think I do a good job of it. I'm not going to be right all the time. That doesn't happen to anybody. But the work doesn't care what I am. The work just said up here, you can't be, when you broke that number, and that happened right here, you can't be long anymore. I was looking for the market to find support against the 18-day average, and now that's eroded. But once you started closing, which is really today under the 18, that puts you in the downtrend. And even then, if you rallied back to 345 to put a stop over the most recent high of 361.50, too much risk. So what have I done for the past 2 days in my market letter for my clients? I've told them to stay in cash. And at the end of it, I'm walking around the office going, hey, I didn't make any, my trade recommendations did not do anyone well. They didn't hurt them either. That's what I'm trying to get at. Nothing's occurred. Sometimes that's called winning. Let's talk about one of the gifts I have for you. And if you look up on our webpage at www.iraepstein.com, I want you to just click the word register. And when you click it, you're going to see this form come up. I want you to hit free trial. And all I ask is that you come down, put in all your information, choose your passwords and everything. Let us give you free charting software to work with, free. Free phone application, quotes, everything coming right through there, and ultimately you'll be able to place your orders. You'll see. You can play with the order entry level already on it. I wake up, I don't turn on my computer. I've got this by my side. It's just so much easier. So that's what I'd like you to do. All right, let's finish up here and get over to the crude. Here's yesterday's crude. Get up to what, 101.45. You didn't take out the previous high. You'd already been in a pattern of lower lows, rally. You'd been trying to stay under the 18-day average. Yesterday you got back over it, and today, bam, you just let go of the market and you came right down to the Bollinger Band, and that's where I think the market's going to try to hold, 95.29 area. That number will drop a little bit tomorrow as we close today up, so it'll be maybe in the 94.50 area, whatever. And that's where I'm going to look for this market to try to just bounce from. But the trend is down. The resistance is now 98.95 until you take out 101.45 on this chart. This is the chart I'm the most proud of. Cocoa. Remember, it was down here, and I said this is the most classic bear market. If I had to write a book about how a Bollinger Band works, this was it. And then we had what's called a key reversal in the market. You took out a previous low, came up, closed higher. At the same time, the slow stochastic red line got over 20, and I said, what I look for is the market to meet the 18-day average like a pinball machine reset. Today, 2272 is the 18-day average of close. 2274 is the high of the day. And you're back to 2180. I won't be showing cocoa again. Just wanted to show you sometimes how these indicators have this uncanny way of giving you a roadmap to what may take place in the markets. The word is may. I wish everything worked all the time. I'm Ira Epstein, and I will see you tomorrow. Have a good evening.